When it comes to finance, the role of the bank, which is a centralized entity, cannot be juxtaposed for anything. The bank is supreme when it comes to the movement of funds across the world, and having that power means that they can do anything with your money, and there's nothing you can do about it, especially when they have the support of the government. The banks and the government makes policies that govern our money, and we do not have a say in whatever policy they make, because they've created a system that always make it look like we've trusted them with such power to make policies on our behalf, especially policies that do not favor us, but them alone. Now, since bank is a centralized entity that works with the government uses the bank against whoever they sees as an enemy, which is a big problem we should be concerned about, because you might become a victim tomorrow. Well, if you become an enemy of the government, they can decide to freeze all your bank account and leave you financially handicapped because the power is in their hands. For example, in March 2022, the Western government was able to issue an economic sanctions to the Russian government for unleashing war to the Ukrainian people because world's economic system is somehow centralized. So, few persons came together and decided the fate of the entire Russian populace because the power is centered in their hands. As you know, most world's organizations runs on centralized system where one or few persons make decisions that affect the rest of the world terribly. Isn't it? How about the Russian oligarchs that aren't resident in Russia? Their major assets were also frozen and seized by the US and UK governments, accusing them of supporting their country to invade Ukraine. They had to suffer for what they may probably know nothing about. Now, you can see the dangers of running a centralized financial system that leaves power in the hands of few. Well, for centuries, we have lived in a world of centralized finance where every country has a central bank that controls the money supply, and financial trading is largely done through intermediaries. Also, borrowing and lending are conducted through traditional banking institutions. Well, in the last few years, however, with the growth of cryptocurrencies, considerable progress has been made on a much different model, leading to what is known as decentralized finance, or DeFi. Brethren, the software running the world is long overdue for update, and the devastating effects is already manifesting at all corners of life. Well, I'm tempted to say that blockchain technology, cryptocurrency, and DeFi is the new software the world needs to update our financial system. Now, DeFi involves peer-to-peer interaction through a common ledger that is not controlled by any centralized organization. You know, the global financial crisis of 2008 exemplified excessive risk-taking by banks, and governments were forced to make massive bailouts of the banks. This crisis exposed the shortcomings of the traditional financial system and highlighted a need for it to be better. Well, DeFi offers considerable potential for solving some key problems associated with centralized finance. It seeks to build a better financial landscape made possible by the advent of the internet and blockchain technology. Hi, I'm Waffer Samtachukwu from Project Cryptocurrency Education. And welcome to today's episode of Crypto Pinkboard Monday, where we take complex cryptocurrency topic, write them down, and explain them in simple English, so that anyone who cares can easily learn and understand. So, in today's episode, we will be discussing in detail what DeFi entails and why it is the future of finance. Before we proceed, do understand that this video is strictly for educational purpose only, so whatever you do with information provided in this video is strictly of your own volition. So, let's continue. Firstly, let's take a look at our traditional financial system. As you know, the highest leveraged institution in our traditional financial system are banks. Banks are the financial industry's giants that facilitate payments, accept deposits, and offer lines of credit to individuals, businesses, other financial institutions, and even the government. But this system has a lot of issues like centralization, easy access to physical/digital robbery, limited access, lack of interoperability, and lack of transparency. Well, there is no denying that traditional, regulated financial institutions that comply with government laws and regulations are some of the most secure places to park funds. But they are not without flaws, because even large banks can fail. In the US alone, Over 500 bank failures have been recorded. And this means that the centralization of power and funds in the hands of the banks is dangerous, and rightfully so. Looking at past incidents. For example, the fall of the Lehman Brothers, which triggered the start of the 2008 financial crisis. Also, if you have tried to send money to someone or a business in another country, you would know this pain all too well. You know, remittances involving banks worldwide typically take a few working days to complete and involve all sorts of ridiculous fees. Now, to make matters worse, there may also be issues with documentation, compliance with anti-money laundering laws, privacy concerns, and more. There is also the issue of accessibility. According to report, the World Bank estimates that as of 2017, there were 1.7 billion people who do not own an account at a financial institution, and more than half of them are from developing nations. According to World Bank, these people come mainly from poor households, and some of their main reasons for not having a bank account are poverty, geographical, and trust issues. So, these prevalent issues in our traditional financial system is what DeFi aims to solve. In short, DeFi opens up huge windows of opportunities and allows users to access various financial instruments without any restriction on race, religion, age, nationality, or geography. Now, the question is, what exactly is DeFi? DeFi, short for Decentralized Finance, is a movement that enables users to utilize financial services such as borrowing, lending, and trading without the need to rely on centralized entities. These financial services are provided via decentralized applications called dApps, and the majority of these applications are deployed on the Ethereum platform. Now, DeFi is not a single product or company, but a range of financial services which emulates traditional financial industries, including banking, insurance, bonds, money markets, and more. So, DeFi dApps enable users to combine these services to achieve their desired financial goals. Now, for DeFi dApps to work, a collateral locked into smart contracts is usually required. And the cumulative collateral locked in DeFi dApps is often referred to as the total value locked, which serves as a growth indicator of the DeFi ecosystem. According to a new research report, the total value locked in DeFi increased from $601 million at the start of 2020 to $239 billion so far in 2022, which is a 40,000% rise. This means that the DeFi ecosystem is growing massively, and it should be somewhere where everyone who cares about their finance should position themselves. Now, DeFi runs on the blockchain. And blockchain is a decentralized, distributed public ledger where financial transactions are recorded in computer code that cannot be altered or hacked. This means that everyone using a DeFi app has an identical copy of the public ledger, and there is no middleman or gatekeeper managing the system. This makes financial transactions secure and more transparent than the private, opaque systems employed in centralized finance. As we said earlier, the majority of the DeFi dApps are currently being built on the Ethereum blockchain. But what exactly is Ethereum? Ethereum is a global open-source platform for decentralized applications. You can think of Ethereum as a world computer that no one can shut down. On Ethereum, software developers can write smart contracts that control digital value through a set of criteria and are accessible anywhere in the world. And smart contracts are programmable contract that allows two counterparties to set conditions of a transaction without needing to trust another third party for the execution. For example, if Alice wants to set up a trust fund to pay Bob $100 at the start of each month for the next 12 months, she can program a smart contract to do the following. 1. Check the current date. 2. Send Bob $100 automatically at the start of each month. And 3. Repeat until the fund in the smart contract is exhausted. So, from our example you can see that using a smart contract, Alice has bypassed the need to have a trusted third-party intermediary to send the trust fund to Bob and made the process transparent to all involved parties. Smart contracts are the building block of decentralized applications. Multiple smart contracts are combined together to form what is known as a decentralized application. However, other dApps projects are being built on the Polygon and BSC blockchain due to the high gas fees in the Ethereum platform. And a gas fee is a fee that is paid whenever transactions and smart contracts are executed on the Ethereum blockchain. Now, let's take a look at 9 major DeFi protocols available in the market today. Number 1 is stable coins. Stablecoins are a viable solution to high volatility issues surrounding cryptocurrencies and are helping DeFi gain prominence. Just like its name, stablecoins are coins whose value are tied to a relatively stable asset like gold or the US dollar in order to keep its price consistent. They help users to hedge against the price volatility in cryptocurrency and allow for a reliable means of exchange. Stablecoins have since quickly evolved to be a vital component of DeFi that is pivotal to this modular ecosystem. Well, there are lots of stablecoins, but the native stablecoin most widely used in the DeFi ecosystem is DAI. And DAI is a decentralized crypto-collateralized stablecoin. Its value is pegged to $1 through protocols voted on by a decentralized autonomous organization and smart contracts. So, at any given time, users can easily validate that the collateral used to generate DAI exists. DAI was launched in 2019 by Maker, which is a smart contract platform that runs on the Ethereum blockchain. While stablecoins are not financial applications themselves, they are essential in making DeFi applications more accessible to everyone by having a stable store of value. Now the number 2 DeFi protocol is lending and borrowing. You know, one of the biggest services offered by the financial industry is the lending and borrowing of funds, which was made possible by the concept of credit and collateralization. However, this system requires some form of trust and an intermediary. The industry also requires users to have bank accounts to utilize their services, a luxury that 1.7 billion people do not have. So, decentralized lending and borrowing remove this barrier, thereby allowing anyone to collateralize their digital assets and use this to obtain loans. One can also earn a yield on their assets and participate in the lending market by contributing to lending pools and earning interest on these assets. Well, with decentralized lending and borrowing, there is no need for a bank account nor checking for credit worthiness. Now, capital lending is also no longer enjoyed only by the wealthy, with emergence of DeFi. In the DeFi space, everyone can contribute to a decentralized liquidity pool that borrowers can take from and pay back at an algorithmically determined interest rate. Also, in contrast to applying for a loan from the bank where there are stringent Know Your Customer (KYC) and anti-money laundering (AML) policies, one only needs to provide collateral to take a loan in DeFi. Now, the 2 leading DeFi lending and borrowing protocols are Compound Finance and Aave. Both Compound Finance and Aave are lending protocol developed on the Ethereum blockchain that allows users to gain interest by lending out assets or to borrow against collateral. The protocol makes this possible by creating liquidity for cryptocurrencies through interest rates set using computer algorithms. Users of these lending platforms earn interest by depositing cryptocurrencies. Once cryptocurrencies are supplied on the platform, users can use them as collateral for loans. However, Aave is more complex than Compound as it offers more flexibility and features. So, the number 3 DeFi protocol is Decentralized Exchanges or DEXs. But before we go into detail about this, please give this video a thumbs up, hit the like button now, if this video has made sense to you so far, and if this is your first time of coming to our channel, go ahead and subscribe now, and as well turn on the notification bell so that you will be among the first persons to get notified whenever we post educational videos like this, and that will also help you never to miss out on any of our content. Thanks for hitting the like button, as that will make YouTube to show this video to many other persons, and we all benefit from the information we shared in the video. So let's continue. Decentralized exchanges or DEX for short are one of the essential functions of DeFi, with the maximum amount of capital locked compared to other DeFi protocols. DEXs allow users to exchange or swap tokens with other assets, without a centralized intermediary or custodian. You know, to exchange one cryptocurrency for another, one can use exchanges such as Coinbase or Binance. Exchanges like these are centralized exchanges, meaning they are both the intermediaries and custodians of the traded assets. Users of these exchanges do not have complete control of their assets, putting their assets at risk if the exchanges get hacked and are unable to repay their obligations. Decentralized exchanges aim to solve this issue by allowing users to exchange cryptocurrencies without giving up custody of their coins. By not storing any funds on centralized exchanges, users do not need to trust the exchanges to stay solvent. Well, there are two types of DEX. We have order book-based DEX and liquidity book-based DEX. Order book-based DEX, like DYDX and DEFI, operate similarly to centralized exchanges where users can set buy and sell orders at either their chosen limit prices or at market prices. The main difference between the two is that for CEX, a short for centralized exchange, assets for the trade would be held on the exchange's wallets, whereas for DEX, assets for the trade would be held on users' wallets. On the other hand, liquidity pool DEX, such as Uniswap and Balancer, let users become the market makers by providing liquidity to a pair or pool of assets. Users deposit their assets and become liquidity providers, earning a small fee for each swap transaction performed for that particular pool. Now, the number 4 DeFi protocol is derivatives. A derivative is a contract whose value is derived from another underlying asset such as stocks, commodities, currencies, indexes, bonds, or interest rates. So, traders can use derivatives to hedge their positions and decrease their risk in any particular trade. For example, imagine you are a glove manufacturer and want to hedge yourself from an unexpected increase in rubber price. You can buy a futures contract from your supplier to deliver a specific amount of rubber at a specific future delivery date at an agreed price today. Well, the market capitalization of DeFi derivatives (dApps) is $5.82 billion, or 8.2% of the DeFi ecosystem. So, decentralized derivatives have struggled to take off due to the high gas fees on Ethereum. As such, the market capitalization figure is relatively low compared to other DeFi sectors, such as the lending market. The two major DeFi derivative protocols are Synthetix and Open. Just in case you may want to check them out. So, the number 5 DeFi protocol is fund management. Fund management is the process of overseeing your assets and managing its cash flow to generate a return on your investments. Well, decentralized fund management is conducted without an investment manager. Instead, algorithms help you conduct trades automatically. This allows you to choose the asset management strategy that best suits your financial goals and reduces the fees paid. A good example of this is TokenSets. And TokenSets is a platform that allows crypto users to buy strategy-enabled tokens set. These tokens have automated asset management strategies that will enable you to easily manage your cryptocurrency portfolio without executing the trading strategy manually. With an automated trading strategy, you will not need to monitor the market 24/7 manually, thus reducing missed opportunities and risks from emotional trading. Well, each set is an ERC20 token consisting of a basket of cryptocurrencies that automatically rebalances its holdings based on the strategy you choose. In other words, SET essentially implements cryptocurrency trading strategies in the form of tokens. So let's talk about the number 6 DeFi protocol, which is decentralized lottery. You know, putting a DeFi spin onto lotteries allows for the removal of custodianship of the pooled capital into a smart contract on the Ethereum blockchain. Well, with the modularity of DeFi, it is possible to link a simple lottery dApp to another DeFi dApp and create more value. One of the attractions of decentralized lotteries is that funds do not go through intermediaries or brokers, but are instead held by audited smart contracts. There is also no lockup period on funds, meaning that users can withdraw their funds at any moment. Furthermore, the prize draw can be verified on-chain in Ethereum to make sure there is no manipulation. Traditionally, the protection laws of the gambling industry have made real-world no-loss lottery, such as PLSA programs, restrictive to users from certain geographical areas to join. This is where decentralized applications genuinely shine, so anyone from anywhere can participate if they have the funds to do so. Well, one DeFi dApp that allows participants to pool their capital together is called Pull Together. Pool Together is a decentralized no-loss lottery or decentralized prize savings application where users get to keep their initial deposit amount after the lottery prize is drawn. Instead of funding the prize money using the lottery tickets purchased, the prize money is funded using the interest earned on compound protocol by the pooled user deposits. For each round of Pool Together, all the user deposits are sent to compound to earn interest. One lucky winner will be selected at random at the end of each interval to win the entire interest accumulated as prize money. Now, the number 7 DeFi protocol is decentralized payments. In decentralized payment, a key role of cryptocurrency is to allow decentralized and trustless value transfer between two parties. One can already make decentralized payment by sending Ether or DAI directly to the receiver. Now make it better: think cheaper and faster transactions, timed transfers, transfer by conditions, standardized invoicing formats, and more. With the growth of DeFi, more creative payment methods are being innovated and experimented upon. A good example is Sablier. Sablier is a payment streaming application. This means that instead of waiting for a fixed period for payers can now send payments in real time in periods defined and agreed upon by both parties. It also helps payees to receive their payments in real time and withdraw whenever they want to. So the number 8 protocol is decentralized insurance. As you know, insurance is a risk management strategy in which an individual receives financial protection or reimbursement against losses from an insurance company in the event of an unfortunate incident. It is common for individuals to purchase insurance on cars, home, health, and life. But is there decentralized insurance for DeFi? Yes, there is. Amazing, right? Well, all of the tokens locked within smart contracts are potentially vulnerable to smart contract exploits due to the large potential payout possible. While most projects have gotten their code bases audited, we never know if the smart contracts are truly safe, and there is always a possibility of a hack that may result in a loss. The risks highlight the need for purchasing insurance, especially if one deals with large amounts of funds on DeFi. Providers of decentralized insurance includes Nexus Mutual, Ensure Network, and Cover Protocol. You may check them out for a detailed information just in case you're interested in any of them. Finally, the number 9 DeFi is governance. Governance is essentially crypto's idea of business management. In order for DeFi protocols to manage a project, governance tokens are often introduced to give users voting power and have a say in the protocol's roadmap. Naturally, multiple toolkits and dApps have also been developed to facilitate effective governance and complement existing systems. DeFi governance protocols organize themselves as decentralized autonomous organizations, DAOs, which are organizations governed by smart contracts on the blockchain. DAOs allow groups of people to cooperate without centralized management and coordinate around a shared set of rules to achieve a common mission. To address DeFi protocol governance, projects such as Compound pioneered the governance token model. Governance tokens provide voting power, allowing token holders to vote on protocol proposals that any community member can submit. So, basically every financial service offered in our traditional financial system is also offered in the DeFi ecosystem with more advantages and benefits. Well, decentralized finance provides compelling advantages over traditional finance along the verticals of decentralization, access, efficiency, interoperability, and transparency. It also allows financial products to be owned collectively by the community without top-down control, which could be hazardous to the average user, as well as grant access to these new products for all individuals, is thereby preventing widening wealth gaps. You know, traditional finance exhibits layers of fat and inefficiency that ultimately remove value from the average consumer. The contractual efficiency of DeFi brings all of this value back. As a result of its shared infrastructure and interfaces, DeFi allows for radical interoperability beyond what could ever be achieved in the traditional finance world. Finally, the public nature of DeFi fosters trust and security where there may traditionally exist opacity. The true potential of DeFi is transformational. Assuming DeFi realizes its potential, which it definitely will, the firms that refuse to adapt will be lost and forgotten. All traditional finance firms can and should begin to integrate their services with crypto and DeFi as the regulatory environment gains clarity and the risks are better understood over time. Well, startups such as Dharma are leading this new wave of consumer access to DeFi. This approach will still suffer from added layers of inefficiency, but the firms that best adopt the technology and support local regulation will emerge as victors while the others fade away. The DeFi protocols that establish strong liquidity moats and offer the best utility will thrive as the key backend to mainstream adoption. Well, what we are seeing in the DeFi ecosystem is not a renovation of the existing financial structures, rather it is a complete rebuild from the bottom up. This is amazing because, with DeFi, finance becomes accessible to all. Quality ideas are funded no matter who you are or where you are from. As a matter of fact, $10 transaction is treated identically to a $100 million transaction. Savings rates increase and borrowing costs decrease as the wasteful middle layers are excised. It is obvious that with DeFi, we can do better and more in the finance world. Undoubtedly, DeFi is the future of finance. And ultimately, we see DeFi as the greatest opportunity of the coming decade and look forward to the reinvention of finance as we know it. That will be all for today's video, but before you go, please help other persons to see this video by hitting the like button, because when you do, YouTube will show the video to more persons, and we all learn and be informed about what DeFi are and how we can benefit from it. Well, if this video made sense to you in any way, or you learned anything new from the video, drop me an appreciation comment below, for that will be big encouragement to me and my team. And in case you have any question about cryptocurrency, even if it's not related to this video, drop it below, and I will definitely answer them. And if your question is great, we will do a video about it, and give you a shout out in the video for asking such a beautiful question. Please share this video to anyone you think it would be beneficial to. And when you do, you're helping us accomplish our mission of educating the world about cryptocurrency, blockchain and all that's associated with it. And many thanks indeed for watching.